from everywhere you're watching me. Today's channel, Accounts and Business Made Easy, is the channel. Today's topic is provision for depreciation and disposal accounts. Please, if you have watched depreciation in this channel, you are good to go. But if you haven't watched depreciation as a topic in this channel, you are kindly requested to do so. However, just follow through. This topic is going to be an interesting topic. Depreciation is just a relevant previous topic which was released already in this channel. So for provision for depreciation, we try to show the value of reduction of assets for each year, non-current assets. Then for disposal account, we prepare it to show whether the business made a profit or loss on disposal of an asset that is no longer of use, or an asset that a firm wants to exchange for a new asset. So that is what we're going to touch today: how to prepare depreciation account, provision for depreciation account, and disposal account. So let's touch this example. Okay, a firm purchased machinery for $5,000 on January 1, 2010. That is the purchase cost. It is sold or purchased by a firm for $5,000. It is expected, the asset is expected to last for 5 years. So the scrap value is expected to be $1,000. It was sold in December 2013 for $1,500. So we are required to prepare provision for depreciation account and disposal account. This information does not specifically give us method of depreciation. So we will assume straight line method of depreciation. We have in the topic depreciation as was released in this channel. Depreciation can be valued using straight line method, using reducing balance method, using revaluation method, using some of the years decade method. There are various methods we can use for depreciation of an asset. But in this case, we want to use straight line method. In which case, to get the value of depreciation for each year using straight line method of depreciation, we use this formula: cost minus scrap value divided by estimated number of years will give us the value of depreciation for each year. So the cost in this question is $5,000 minus the scrap value. The scrap value in this question is $1,000. And the estimated number of years is expected to last for 5 years. So depreciation for each year is equal to 4,000 divided by 5, which is $800. That means for each year, it is expected that the value of the asset will reduce by $800. And at the end of the 5th year, it is expected to still have the value of $1,000. Hence, for each year, $800 will be the value of the asset. Now, at the end of year 4, the whole of 2010 is 1 year for the asset. The whole of 2011 is 1 year. The whole of 2012 is 1 year. The whole of 2013 is 1 year. And at the end of that year, it's expected to last for 5 years, don't forget. So that means the asset did not even spend the 5th year before it was sold off. And it was sold off for 1,500. So let's prepare the depreciation account first. Provision for depreciation account. So in year 1, which is the January 1, 2010, the value of depreciation for each year is 800. Let us not forget. So this will be charged to income statement. The value is $800. So at the end of the balance carried down at the end of year 1 is $800. And at the end of year, so we go to year 2, which is 2011. So, but first we bring the balance down. Balance brought down from the first year, 800. So for 2011, the value of depreciation for second year is also 800. That means the total depreciation at the end of year 2, the second year, is 1,600, which will be the balance carried down here. Then in 2012, the balance that is brought down, that means the total of depreciation as at that date. So that means at the end of first year, that's at the end of 2010, the depreciation was 800. At the end of year 2, which is 2011, the depreciation would rise to 1,600. That's 800 of first year and 800 of second year. So in year 3, which is 2012, the total that was brought from year 2, which is balance brought down, is 1,600. So the depreciation of year 3 is also 800. Don't forget, we are using straight line method of depreciation. That means 800 is the amount that will be charged to income statement as an expenditure. When we get to that topic, we'll explain that further. Now, if you add this gives us 2,400. So at the end of year 3, 2,400, then balance carried down is 2,400. Then we bring, that means if you follow me, 800 in year 1, 800 in year 2 for depreciation, 800 in year 3 for depreciation. The total gives us 2,400. That will be the total existing provision for depreciation. So that is 2,400 for year 4. We bring it down from year 3. Balance brought down 2,400. So for year 4, which is 2013, what is the provision? What is the value of depreciation? Still 800. And where do we charge that to? It is charged to income statement. Income statement. So the total of depreciation at the end of year 4 is 3,200. Now, remember in the question, at the end of year 4, the asset was sold off. The asset should have lasted for 5 years, but it spent only 4 years, and at the end of year 4, it was disposed, it was sold off. That means that asset will be discontinued. The existence of that asset will be discontinued from the end of year 4. So what we simply do is, instead of writing usually, we will bring it as balance carried down, 3,200. But now the assets cannot go to next year, which is year 5. The asset will not cross to year 5. So instead of balance carried down, it will be written off to disposal account, which is 3,200. So instead of balance carried down and bringing it down to year 5, the asset will stop its existence at the end of year 4. So this is year 1, this is year 2, that's 2010 ending, 2011 ending, 2012 ending, that's year 3, then 2013 ending, that's year 4. And at the end of that year, it was disposed. So we will not continue the asset. This is the end of provision for depreciation account using this question, using straight line method of